Welcome to the Explainer. Today, we're jumping into a really popular strategy that claims to pay you in 3 different ways, even when the market is totally flat. It's called the options wheel. We're going to break down how it works, if it actually beats the market, and, stick with me, a pro-level secret to make it way more profitable. All right, let's kick this off with a problem that I'm sure a lot of you have faced. You're looking at your portfolio and the market is just stuck, right? It's not going up, it's not crashing, it's just moving sideways. So the question is, how do you generate any kind of return when your stocks just aren't moving? Well, this is where the options wheels strategy rolls in. You'll often hear it called the triple income strategy, and for good reason. The whole idea is to generate a consistent stream of cash from high-quality stocks, the ones you'd be happy to own anyway, no matter what the market is doing. And don't worry, we're about to break down exactly where those 3 streams of income actually come from. So how does this thing really work? Well, it's not just a one-off trade. Think of it more like a continuous 4-step cycle that's designed to keep you collecting income over and over. Let's walk through it right now. Okay, so this is the entire loop in action. You start by selling what's called a cash-secured put. Now, if the stock drops, you might get assigned the shares, which just means you have to buy them. From there, you turn around and start selling covered calls on those very same shares. Then, if the stock price pops, your shares get called away, meaning they're sold, you pocket the profit, and boom, the wheel starts spinning all over again. Let's zero in on that first step, selling a cash-secured put. Honestly, it's kind of like getting paid to place a lowball offer on a stock you already like. You collect a fee right up front. It's called a premium, just for agreeing to buy the stock if it dips to a price you're already comfortable with. And that premium, that's your income stream number 1. You literally get paid just to wait. Okay, so what if you do end up buying the stock? Then you just move on to the next phase, selling a covered call. The best way to think about this is like you're renting out your shares. You own the stock, and now you're collecting another premium. Bam, that's income stream number 2. And hey, if the stock happens to pay a dividend while you're holding it, well, there you go. That's your 3rd stream of income right there. This table really pulls it all together beautifully. You can see how each phase has its own goal, but the main objective, the big picture, is always the same. Keep collecting premium from the market. In phase 1, you collect that put premium. If you get the stock, you flip over to phase 3 and start collecting call premium. The whole point, no matter what, is to always have some kind of position out there that's just generating cash for you. But let's be real, here's the million-dollar question. Does this triple income promise actually beat a simple buy and hold strategy over the long run? The data, well, it might not be what you think. According to a really in-depth backtest from the research group SpinTwig, the answer is a pretty clear no. They put the wheel strategy to the test on the S&P 500, looking at data all the way from 2007 to 2024. And what they found was that consistently it underperformed just buying and holding. So why? Why does it tend to underperform? Well, in a strong, ripping bull market, your profits are capped. Think about it. Those covered calls you're selling, they act like a ceiling on your profits. Your shares get sold away before they ever get a chance to really take off and give you those huge portfolio-changing gains. But, and this is a big but, the strategy definitely has its sweet spot. In flat or even slightly down markets, the wheel can be an absolute winner. I mean, look at this table. When the market's just drifting sideways, the buy and hold person is making 0. But you're still collecting those premiums. And in a mild downturn, that premium you collected acts as a cushion, softening the blow, and maybe even helping you lose less than someone just holding the stock. So it's pretty clear this isn't some magic bullet for crushing the market. And there are 2 massive pitfalls you absolutely have to know about before you even think about trying this: picking the right stocks and a really nasty tax trap. Seriously, this entire strategy lives or dies by the stocks you choose. This isn't about speculation. You have to pick companies you'd genuinely be happy to own for the long haul, because there's a good chance you'll have to. That means sticking with stable, blue-chip companies, and for the love of all that is holy, staying far, far away from those super volatile meme stocks. And then there's the big one. There's this huge tax trap called the wash sale rule. Basically, if you close an option for a loss and then open a really similar one within 30 days, the IRS says, nope, you can't deduct that loss. It can literally create a nightmare scenario where your account statement says you lost money for the year, but you still get a big tax bill. No, thank you. Okay, so you're probably thinking, why would anyone deal with that? Well, here's the thing. Sophisticated traders don't.
They have a way around these tax problems, and they use a specific tool that makes this whole strategy way more efficient. So here's the secret. Instead of messing with options on individual stocks or even ETFs, the pros often trade options directly on the big indexes, like the S&P 500, using tickers like SPX. These are special kinds of options, and they come with a much, much better tax treatment.
And this right here is the biggest advantage. Under the tax code, any gains from these index options get special treatment. 60% of your gains are taxed at the lower long-term rate and only 40% at the higher short-term rate. This gives you a blended tax rate that is way lower. I mean, look at that number. You're dropping from a top tax rate of around 37% all the way down to about 27%. That is a huge difference. That means you keep more of the money you make. So let's just recap the pro-level upgrade here. By using index options, you get a lower tax rate, you completely eliminate that nasty wash sale problem, and you simplify your life because everything is cash settled. That means you never have to deal with buying or selling actual shares of stock. It's just cleaner.
So at the end of the day, is the options wheel some kind of magic money machine? Look, the data says no. It is not a secret for beating the market in the long run. But what it is a really powerful tool for a very specific job: generating consistent income, especially when the market isn't giving you any help. And as we've just seen, it's a tool that becomes even more powerful when you learn how to use it like a pro.